Hello, everyone. This is Mindy Hoffman with MCS Mortgage Services, NMLS 1669814. You can check it out at the NMLSconsumeraccess.org. You can also check it out at our website, mcsmls.com. So I'm so happy that you've joined us today, and I just wanted to take a few minutes to talk about some differences between FHA and conventional loans for first-time home buyers. FHA loans. Let's talk about this product. It is a really great product to use and it has some benefits. FHA loans are insured by the Federal Housing Administration. FHA requires 3.5% down on the purchase price, and it also allows down payment assistance. You can get down payment assistance programs with FHA for just the down payment of 3.5%. And there's also some programs out there that help you with closing costs as well, where you can get up to 5% in down payment and closing cost assistance. FHA also has a mortgage insurance cost that is upfront. The fee is 1.75%. And they also have permanent mortgage insurance monthly. So where the cost of it does go down, it's still going to be there forever. So on an FHA loan, if you know that this is the house that you want to keep forever, you may want to consider a conventional loan, because with conventional loans, the mortgage insurance goes away. And we'll talk a little bit more about that later. The other benefit to FHA is it allows higher debt to income ratios. So with FHA, you may qualify for more house than you do as if you were going with a conventional loan. FHA generally has lower interest rates available versus the conventional loans. They can have a little bit higher interest rate. So let's take a look at some of the fees for FHA. This is just an example of an FHA purchase with a person who has a 697 score. The purchase price is $650. And these are some general fees that are just estimates, like your title fees are just estimates from, a random title company. The city and county taxes are just estimates. And once you do find a property, then these numbers become more exact because each property has a different property tax associated with it. We're going to just assume that we're going to buy down the rate to get the lowest rate available, and it usually costs around 2 points to get that. Some banks will allow you to go a little higher than that, but just for the sake of an example, we're using 2 points. The interest rate on this loan is 5.25, and the total loan amount is $638,226. So like we had talked about before, there's lots of advantages of going with an FHA loan. Now, I always look at FHA and conventional for all my clients, and this is why. Because while there are a lot of benefits to FHA, FHA has an upfront mortgage insurance fee. And in this example, that upfront fee is $10,976.88. And they allow you to finance this fee. So what it does is it uses up some of the equity that you have in your home to purchase this fee that never benefits you. This fee benefits the bank. It protects them, in case you default on your loan. So then we can take another look at the FHA loan and look at the breakdown of how your payment works. So you're going to have a payment that is your principal and interest right here. And then you have financed into there your property taxes and your mortgage insurance and your homeowner's insurance. Homeowner's insurance is something that you can shop for. This is just, like I said, an estimate. Property taxes are going to be specific to the property that you're purchasing, and mortgage insurance is going to be based on your loan amount. So this mortgage insurance It never goes away with FHA. It will be reduced over time because your loan amount goes down, but it will always be there. So this is something that you want to talk to your loan officer about and just make sure that FHA is the right choice for you. Sometimes you have to work a little bit harder, but sometimes it's worth it to go with a conventional loan if you know that you're going to keep this property forever. So then you have your total monthly payment here and the details of the estimated cash to close on this side. Okay, so we've talked a little bit about how FHA is a great program for first-time homebuyers, and it definitely has some benefits. And now it's time to look at the conventional side of things. Conventional loans now have some really great programs for first-time homebuyers. They have a Home Ready and a Home Possible program for homebuyers that are looking to not have that upfront mortgage insurance fee and looking to also have that availability of the mortgage insurance going away over time. So conventional loans are not government insured, and Home Ready and Home Possible, they have down payment requirements of anywhere from 3 to 5%. Conventional Home Ready and Home Possible, they do allow the same kind of down payment assistance programs where you can borrow the 3% up to 5%. If you do the 5%, it can be for the down payment and closing costs, or it can just be for down payment as well. Conventional Home Ready and Home Possible mortgage insurance, it does go away when your loan to value reaches 80%. So let's just take a look at what this means for you on the fee sheet. So we have the same scenario set up, same score, but the loan amount now you're going to see is different because now we're only putting 3% down and the loan amount is going to match the 97% loan to value. And you can also see on here that the interest rate is 5.875. And we are buying this interest rate down to almost 2 points, just like we did on the FHA loan. So it's just giving you a good example of trying to get the lowest rate possible, and that there is a slight difference in interest rate between a government insured loan and a conventional loan. The rest of the fees are going to be the same, but you're going to notice on here that there is no upfront mortgage insurance fee. So what it does is it allows you to keep that $10,000 as equity, because in the event that you need that equity for something down the road, you can always get a home equity line of credit, or you can do a home equity loan that is a second loan, or heaven forbid you need to sell your property. You know, that extra money and equity can help you find the right real estate agent to list your property and help you sell if you had to move in a hurry. On here, you can see that if you're looking at the monthly payment, there's not a huge difference in the monthly payment overall. The homeowner's insurance is the same, the taxes are going to be the same, and the mortgage insurance is going to vary based on your based on the bank and also based on your credit score. But in this scenario, they're about the same. And that mortgage insurance, like I said, will go away when the loan to value is at 80% or lower. And a lot of times you'll need to call your bank and say, hey, I want you to do, an automated review to see if I can have that mortgage insurance removed. Because sometimes when you buy a property and you do work to it, or, the county does work to your road, or somehow your equity increases, then you're going to be able to have that mortgage insurance dropped sooner rather than just keep paying it for no reason. So I just want to thank you today for joining me, and I hope I answered a lot of questions that you have on FHA versus conventional, and we hope to talk to you soon. Thanks. Have a great day.